If your company operates in more than 3 countries, there is a good chance your finance team is managing more banking relationships, currencies, payment providers, and settlement timelines than they would ever choose if they were building the system from scratch.
The dollar liquidity infrastructure for global commerce.
And the interesting thing is, most companies didn't choose this complexity. It's what they inherited. When they enter a new market, they hire people there, they find local suppliers, they open a new bank account, and they add another payment provider. And before you know it, your finance team is managing 5 different ways to move money across 5 countries. After spending years working around cross-border payments, one thing has become very clear to me. The bigger a company becomes internationally, the more important its financial infrastructure becomes. And that's why I want to explain to you something that I think every CFO, treasury manager, and founder operating internationally should understand: how digital dollars and stablecoins can simplify the way your company moves money around the world. Let's make this practical. Imagine a company headquartered in the United States. It has developers in Eastern Europe, a customer support team in the Philippines, salespeople in Brazil, and suppliers or contractors in Nigeria. The business itself may be doing very well. Revenue is growing, the team is growing, they are entering new markets. But now, look at what happens inside the finance department. The US employees are paid through a US payroll system. The European team is paid through another provider. The Philippines require another payment arrangement, and the Brazilian operation has its own local banking relationship. Then the Nigerian supplier sends an invoice. The finance team initiates a wire, and they are told it could take several days, which is, they're fine with it. They don't always know exactly when the supplier will receive it. So when someone asks, has the payment arrived? The finance team will check with the bank, then the payment provider, then the correspondent bank, then somebody emails the supplier. Can you confirm receipt? And that's one payment. Now multiply that by hundreds of employees, vendors, contractors, and transactions every month. This is where international growth starts creating financial complexity. Not because the business is doing something wrong, but because the financial system was never designed around the way that company now operates. And there are at least 3 costs that come with this. First, the banking complexity. Every country can mean another bank, which is new onboarding process, compliance process, a new account, set of fees, and the system your finance team has to understand. Second is the foreign exchange. Every time you move from dollars to euros, euros to another currency, or dollar to naira, there is a cost. Sometimes you see the cost clearly as a transaction fee. Sometimes it's hidden inside the exchange rate. And when settlement takes a few days, the rate you expected when you initiated the transaction may not be the same when the money finally arrives. So for a company moving millions of dollars internationally every year, Small differences can become real money over time. And the third is reconciliation. This one is easy to underestimate. Your finance team isn't just sending money, they have to prove where the money went, when it left, when it arrived, which invoice it relates to, which entity paid it, which currency was used, and what was the exchange rate used, and whether the amount that left the company is the same amount that arrived. If you have 5 different payment systems, you are effectively asking your finance team to reconcile 5 different systems that were never designed to work together. And that becomes an additional cost of operation. Now, I don't want to make it sound like traditional banking is the problem. It's not. Correspondent banking, international wires, local banking systems, they all solved a very important problem for decades. They were the best way we had to move money between countries. But the world has changed. Companies now operate globally from day one. Employees can live anywhere in the world. A software company in California can have customers in Europe, developers in Africa, contractors in Asia, and suppliers in Latin America. So the business is global, but the financial infrastructure underneath all is still largely organized country by country. And that's where the mismatch begins. So our businesses became global faster than our financial infrastructure did. Now, let me introduce digital money, or say digital dollars. A stablecoin is basically a digital representation of a currency. In this case, a digital dollar designed to maintain one-to-one value with the US dollar. And this is not about cryptocurrency. The important thing is the settlement infrastructure underneath it. So a company can hold digital dollars in an institutional wallet. And when it needs to make a payment, it can send those digital dollars directly to another wallet that belongs to another company, a business, a government, or individual. The transaction can happen anytime, 24 hours a day, 7 days a week, and can be delivered in minutes. So instead of thinking about which bank do I need to use, what are the cut-off times, how long will this take, you only be thinking about who am I paying, how much am I paying, and where does the money need to go. So that's a very different way of thinking about international treasury. So let's go back to our example, the company that needs to pay a contractor in Nigeria. Today, the finance team may initiate an international transfer. There may be intermediary banks, there may be a delay, also FX conversion that needs to happen. And the company may not know exactly when the contractor received the funds. Now, imagine the same company has a compliant digital dollar treasury account. The company holds working capital in digital dollars. The contractor has a compliant dollar wallet as well. So the company sends the payment and the contractor receives the digital dollar in minutes. The contractor can convert those dollars into local currency through an appropriate regulated channel like a payment app, business payment platforms, or bank. So same business transaction, but the settlement infrastructure underneath is completely different. And this doesn't only apply to contractors, it can apply to global payroll, paying workers globally, supplier payments to any part of the world, intercompany transfers or trade payments which includes large amounts for commodity trades, and also for treasury management, which includes for countries, and eventually other financial workflows today that require several disconnected systems. But here is where I think the conversation gets really interesting. The opportunity isn't simply we can send money faster. That's useful, don't get me wrong. But it's not the whole story. The bigger opportunity is simplification. Imagine your company has working capital sitting in different places because you need to support different markets. A dollar account here, an euro account there, local currencies somewhere else. So these are cash sitting in another account because a payment is coming next week. That is capital that is liquid but fragmented. Now, imagine having a digital dollar, digital euro, digital yuan, digital West African CFA that can instantly convert to one another, or a single digital dollar treasury layer that can move across markets when you need it. So you don't eliminate local banking or the need for local currency and regulation. You add another layer underneath the system that makes your financial infrastructure more flexible. And if that digital dollar is structured to generate a return on the capital balances, then you also start asking a different treasury questions. Why should working capital sit idle while it's waiting to be deployed? Now, before anyone gets too excited, let's talk about the question every serious finance leader should ask. How about compliance? This is not something companies should approach casually. You still need KYC, KYB. That KYC stands for Know Your Clients. KYB stands for Know Your Business. AML controls, that's anti-money laundering controls. Transaction monitoring, accounting treatments, tax treatments, internal controls, audit rails, and you need to understand the regulatory requirements in every jurisdiction where you are operating. So I'm not saying take your company's money and put it into a crypto wallet. That's not the message here. The message is understand that financial infrastructure is changing and for the better of your operations. So understand how and where regulated digital dollars can fit into your existing treasury operations. Understand which providers have the custody, the compliance, the liquidity, and reporting infrastructure that you need. Then test it. Start with one corridor, one supplier payments, one payroll use case or treasury workflow. Then measure the results. That's how a serious financial infrastructure gets adopted. I think we are going to see something very interesting over the next few years. Companies won't necessarily talk about using crypto or blockchain. They will talk about faster settlements and access to working capital. They would also talk about reducing payment costs and improving cash visibility. And underneath those systems, there may be blockchain infrastructure quietly doing the work. Just like most people don't think about the internet when they send an email, they just send the email. And that's probably where the technology is going. The technology becomes less visible while the financial system becomes more efficient. And that's really what I'm trying to do with this series. I'm not here to convince you to buy cryptocurrency. I'm trying to help finance leaders, founders, banks, government institutions understand how money is changing and what they can actually do with these technologies. So if you are a company with international operations and you want to understand whether stablecoins can actually um, reduce payment and treasury costs, reach out to me. We are working with companies to identify practical use cases and determine whether where digital dollar infrastructure can fit into their existing operations. And if you want to be part of the companies we work with as Avano Labs rolls out this infrastructure, you can join the waitlist. I will leave the information below because I don't think the future of financial infrastructure is something we should just watch happen. We should understand it, we should test it, and utilize it properly. So follow this series and let's learn together.
Commerce.